Way, it's my great pleasure to welcome Mr. Christopher Whalen to the Pentonomics program. For those of you who don't know Chris, he happens to be the preeminent financial analyst on Wall Street. He proved that to me during the financial crisis. I served on panels with him on the great Kudlow program, and he's objective, he's smart, he can be seen on Bloomberg TV and CNBC, and I have him with me today. And please welcome Mr. Christopher Whalen. Thank you very much for being on the program, Chris.
Well, thank you, Michael. I appreciate the kind words.
You're so welcome. I should mention at the top, you're also the author of the Financial Technology Investor Newsletter, published by Agora, and also you wrote a book called Four Men from Inspiration to Enterprise.
That's right. So all the things you think you know about Henry Ford are probably wrong.
I would highly suggest all of my listeners to go out and get a copy of that. So let's start right with some questions about right in your sweet spot, the banking sector. Banks' risk-weighted capital ratio. Let's talk about that. The risk-weighted capital ratio. It now stands about 7% for the largest bank holding companies and about 10% for SIFI banks, right? Am I correct about in that assumption?
That's right.
Okay.
American banks are the best capitalized banks in the world.
That's a big statement. Let me ask you this question. Is that enough capital? I know there's a lot of people, a lot of regulators out there who say that's not nearly enough. And I want to just mention this. I did some research on this with Bloomberg. You know, back in the middle 1800s, bank capital was 60%.
Yeah.
60% capital ratio in the mid 1800s. Is that enough capital? Are we safe from another crisis a la circa 2008?
Well, it is enough capital, Mike, and the reason is that the crisis is not caused by a lack of capital. The crisis was caused by securities fraud, by banks like Citigroup hiding their liabilities from investors. And when investors realized what was going on, they were surprised, and we had a crisis. You know, that's the definition of systemic risk, is when you surprise everybody. You hide the money, and then they see it, and they realize that they have no idea if your financials are any good or not. So that's the issue, not capital.
And should we be thinking about capital ratios or leverage ratios? Why don't you tell our audience the difference, and which is more important, or are they both important?
Well, they're both important. American banks are in good shape because regulators like Sheila Bair and her colleagues at the FDIC stuck with the old-fashioned leverage ratio, which is basically assets versus capital. Very simple.
Right.
The world of Basel and the Fed and the other regulators around the world, they start playing around with the numbers, and they weight the different assets on a bank's balance sheet by risk. So the number they come up with looks better. Deutsche Bank is a great example of this, but the bank really doesn't have any capital. So the leverage ratio is the traditional American way of looking at this, much more conservative. And that's why the U.S. banking system was able to navigate through the crisis, clean up its own mess by and large, and move on. Whereas Europeans, the other nations around the world, the Japanese, for example, have not. So
you're not recommending European banks this time, doesn't sound like it.
No, they don't have enough growth in Europe to fix their economy, to charge off bad debt, and clean up the mess. You know, when you charge off bad loans, Mike, you hit capital. And you can't just bail in people and turn debt to equity. With a lot of these banks in Europe, they need to raise new money. The Italian banks, for example. And so, you know, Europe is a very debtor-friendly environment. They don't have independent bankruptcy courts. So it takes years, decades to resolve bad loans. And that's what's wrong with European banks. They're zombies. They really don't have any capital.
Wow.
They don't make any money. And Mario Draghi keeps on life support.
I was just going to say, thank God Mario Draghi. Is he buying $80 billion?
Oh, don't say that.
He went to $60 billion, right?
Mario made a mess in Italy when he was head of the Bank of Italy. He's the one that caused the problems, and they merged the bad bank into Banca Monte dei Paschi di Siena, that you were reading about last year, right?
Right.
Now that bank's probably going to have to be restructured again. And it's because the central bankers refuse to deal with problems head on. They just merge the bad bank and the good bank. And you end up with a zombie. right? You know, if the zombie bites you, you turn into a zombie. So, you know, and this is the Fed too. The Fed has done the same thing. They refuse to deal with bad banks. They merge them with good banks, and you end up with a bad bank.
Yeah, we haven't solved too big to fail from my calculations. So one of the reasons I wanted to have you on the show, Chris, is I want to talk about this so-called zero weighting. Now, commercial banks now hold twice as many treasuries as they did prior to the crisis, about $2.4 trillion worth of treasuries. And what's the risk weighting on a U.S. Treasury note? It's 0.
That's correct.
So nobody can answer this question better than you. Your objectivity is without question. Should we be counting treasuries at a 0 risk weighting? I don't know the answer. You tell me.
Well, the whole post-war, World War II, world of finance assumed that governments are 0 risk weight. So if you were a member of the OECD, you know, regardless of what country you were talking about, they assumed you had a 0 risk weight.
Maybe Greece. Did you throw Greece in that mix too, Chris?
Oh, yeah, absolutely. So that's changed a bit over time, but you're asking the right question, which is that many public entities, countries, have so much debt that they'll never be able to pay it back. Should we treat them as perfect credits, AAA credits? No, obviously not. But the problem is that the governments control the money. So the assumption is that they can print money like Mario Draghi or the folks in Japan or even the Fed, and everything will be fine because you're going to get paid back these pieces of paper. The problem is that the paper is worth less and less.
Yeah. So here's the question. So let's just say we have a bond market. I wrote a book called The Coming Bond Market Crisis, and I am 100,000% convinced that when you have the combination of $14 trillion worth of negative yielding sovereign debt, that's what we had at the peak about 6 months ago, and you have inflation targets of 2%, and you have, you like to use the word zombie, I agree 100%, you have zombie nations like Japan with a debt-to-GDP ratio of 250%. I mean, that's a pretty dangerous cocktail. What happens to these banks if we have a debt crisis where yields skyrocket, bond prices plunge, and that 0 risk weighting turns out to be not so 0 risk weighting at all?
Well, the governments would be forced to come to the rescue of the banks, because if you go back to the crisis, what was the Fed really worried about? Were they worried about banks? No. They were worried about maintaining the liquidity of the market for U.S. Treasury debt. So if you follow that logic, they always will take whatever action they have to take, even if they have to buy the bonds themselves. So if you had a big move in interest rates, investors fleeing Treasury bonds, the Fed's going to come in and buy them. And ironically, you know, I'm sure this has occurred to you, the new rules for liquidity and Basel III and everything else force the banks to load up on government debt.
Right.
Instead of helping the private sector, we're out buying Treasury bonds. So the whole system is very government-centric, and the private sector, smaller banks, non-banks, are clearly subordinate to the government-sponsored entities, which are, you know, the top 10 banks, Fannie, Freddie, Ginnie. All of them are privileged, and everybody else is subordinate to them in this great cosmology we have in American finance.
So let's say we do get inflation. Let's just bet on the fact that eventually central banks will be successful. Well, wouldn't that cause a deluge of selling from the private sector? Don't forget, we have the Fed now, excuse me, the Fed is now threatening to unwind its $4.5 trillion balance sheet, I think, beginning later this year. So you might have the Federal Reserve selling treasuries, banks might have to be forced to sell treasuries, the private sector might want to sell treasuries. Who's gonna buy these treasuries? I can't imagine who's going to be the buyer of a 2.2% 10-year note if we ever get inflation rising to 2, 3, 4%. Who's the buyer going to be?
And we're going to find out, because debt issuance by the Treasury has been relatively low for the past few years. The deficits have been low for a lot of structural reasons, but now they're getting ready to go up a lot. So I think your timing in terms of your book and your overall thesis is correct. The difficult part is that there's no population growth. So you don't get much demand pull inflation, but you do get rising costs, which are killing people because their incomes aren't going up. Remember in the 70s, everybody's income was going up, and you had high inflation.
Real income. We're talking about real income now.
Exactly. So today you have a different problem, which is stagflation. And I think you're right. As issuance by the Treasury goes up, you will start to see pressure on yields, but not right now. You know, the Fed has created a drought of duration of paper. So investors are so hungry. That's why I've been saying 10-year, we go back to 2%.
You agree with Gunlock and Scott Meinhardt? And also
in the bond market, we're going to have another record quarter for high-grade debt issuances this year. 2/3 of it's refinancing debt that was used to buy back stock. So the leverage on the system is extraordinary, and there's just not enough paper. Meanwhile, equities is, debt. There's nothing going on in equities right now. There's no IPOs of any quality. So you have a weird situation.
Snapchat. That's worth a few billion. You put monkey ears on somebody's face, it's worth a few $1 billion of.
Look, with our new newsletter with Agora, I'm very focused on fintech because the traditional banks, the street thinks higher rates are going to help them. No, that's a medium-term proposition. Deregulation, again, medium-term proposition, not this year.
Okay, listen, one more thing I want to talk about commercial banks. So what about their other assets? They got credit card debt, student loan debt, credit card debt, student loan debt, and auto debt. What about these assets? Are they on solid footing?
Well, the asset class you got to watch, Mike, is commercial real estate and also commercial and industrial loans, because banks love making business loans, but those business loans tend to be connected to somebody who owns a commercial property. So at the end of the day, banks are really all real estate risk. Auto loans for banks, the prime loans are not a problem. The subprime stuff, which is mostly a non-bank market, is much more problematic. You can read about that in the financial slips. Credit cards, not so much. The default rates are all going up, but from a low base. But the real mischief of Janet Yellen and the FOMC was done in commercial real estate. If you think of it as a pendulum, in the 2000s we had fun with residential real estate. This time around it's commercial. Look at New York.
Wow.
We're so overbuilt, it's not even true. And there's much, much more inventory coming online this year next. So you'll see some big defaults in the commercial space.
Oh, I was in central New Jersey, and driving around the strip malls, their vacancy rates have surged.
Yeah, the retail is dead. And everybody's like, first quarter retail numbers were awful, and they're like, oh, they're going to get better. When?
when the weather improves, Chris, it's always about the weather.
That's right. That's right.
So you think, according to my calculations, we've had 100 months of a Fed funds rate that's below 1%. 1%
right.
or below. Talk a little bit about the distortions that created in bank assets and in commercial real estate.
Well, what it did, Mike, it skewed risk preferences. So you had single B, double B companies out raising money at investment grade spreads. And this has gone on for a while. You also had a lot of public companies out borrowing at very cheap rates and buying back their stock, which is why the stock market's been going up. There's no supply. In fact, you can compare the U.S. stock market and the residential real estate market. They're both in a supply squeeze. There's very little home building because the banks don't want to lend on it. So you have an economy with huge distortions caused by the Fed. They're social engineering because they don't know what else to do. They know that just lowering rates doesn't affect income. It doesn't affect consumer buying behavior anymore, unlike, say, 20, 30 years ago. So their final effort is to go out and manipulate asset prices. So they caused the bubble in oil. They caused a big bubble in commercial real estate. So those are the sectors I'm really focused on. Autos, yeah, the below prime stuff in autos is going to turn rancid as well. It won't affect the bondholders so much, but it'll definitely be an expense for all of the lessors who are out there leasing cars to people.
Yeah, I was listening to Stanley Fischer this morning on CNBC talking about how he's going to be able to normalize interest rates, and by, I think their neutral rate, they mean by at least 2.5% on the Fed funds rate. I'm looking at the 10-year note today at 2.2%. So if I have a Fed funds rate at 2.25 and a 10-year at 2.25, my math says that's a flat yield curve
Yeah, yeah.
And I've always wondered why. Maybe I'm wrong about this. I've always wondered why these geniuses that run the Federal Reserve always think that when they raise the Fed funds rate, that the long end of the yield curve that yield must also rise. That's really not always the case, is it, Chris?
No.
And why?
The Fed only controls short-term rates.
Right. So what is my question to you is, do you think, I really want your opinion, not just my opinion, what your opinion is, will the Fed be able to normalize interest rates, take that Fed funds rate above 2%, and also be able to unwind its longer dated purchases of mortgage-backed securities and treasuries? And do you think that's going to have a, I would say, negative effect on the economy?
I don't think it's going to affect the economy, but I do think that the Fed is displaying remarkable naivete, even Fisher, who I've got a lot of respect for, when it comes to their portfolio. You know, after the crisis, they dropped rates, then they started quantitative easing. So for me, if you're going to unwind this, you've got to start lightening up on the portfolio, especially the mortgage backs. You know, you want to keep the treasuries, you want to keep the balance sheet bigger than it was before the crisis. Okay, but you know, given that we're going to be down $300 to $400 billion in issuance this year in the mortgage market because of the move of the 10-year after the election, you would think that the Fed would kind of put on their market cap and realize that they've got to dribble supply into the market, or else rates are going to go down. They have to go down. So you hit it on the head. We don't want a flat yield curve. We don't need that right now. That'll cause a recession. And I think that may already be baked into the plan. But I think the Fed ought to be selling $50 to $100 billion a month in MBS, easily absorbed by the market. I doubt it would make any difference to the Fannie Freddie market right now. And that way we could at least alleviate some of the squeeze we have. Because think about it, the Fed was buying all the production 2 years ago.
Right.
And now we're down 20-30% on origination volume because refinancing went away. In fact, even purchase volumes are soft now. So we could do, last year we did $2 trillion in new mortgages in the United States. This year it could be 1.5.
Wow.
Which is not good.
No.
And that's
all the millennials are living with their parents in the basement. I just saw an article about that. They just don't want to move out. I guess they're too busy paying back that.
Look, the millennials have different priorities. They're very conservative. It's really remarkable. You know, grandma's the reckless one. The parents are a little more conservative, and then the millennials, forget it. They're very conservative.
I guess they're too busy paying back that $37,000 student loan.
Exactly.
Let's just talk a little bit about Dodd-Frank and the Volcker Rule. What are the chances of significant changes during the Trump administration to either one of those two entities?
I think you'll see some changes to the General Dodd-Frank. Jeff Hansarling, the chairman of the House Financial Services Committee, is retooling his proposal. It's called the Choice Act. He should have it out in the next week or so, kind of version 2, if you will. The Volcker Rule, no. I don't think they're going to change it because the conflict between the dealer side of the House and the lending side of the House is quite profound. You know, I've talked to Chairman Volcker about this, and I support him. I'm going to go to bat and you know, really fight any changes in the Volcker Rule because it was necessary. Now, having said that, I think we ought to go even further, which is to divide the House. You have the dealer able to trade its own account, the bank, no. You want the conflict rules on the bank side.
Wow. All right, I think we have time for one more question. I want to ask you, do you think we're going to get, and might be a little bit outside of your wheelhouse, but I don't think it is. I'm going to take a chance at this. Do you think we're going to get tax reform this year or tax cuts this year, either one? What do you give an odds on either one of those?
Based on the signals we see coming from the White House, I'm not sure we get either. If, you know, the folks,
really?
Fox last week, Charlie Gasparino was saying that the tax cuts, the corporate tax cuts, are being abandoned by Trump, and he wants to go to some kind of Argentine tax repatriation scheme for all the offshore transactions home, right?
Probably coupled with infrastructure. I think that's what.
Yeah. So I'm not sure. You know, that the Trump people have been showing a little bit of clumsiness when it comes to politics. The easy thing to get done was Dodd-Frank reform, then tax cuts, and then affordable care. to me, just in terms of degree of difficulty.
Right.
So my hope is that we get trade reform on track moving, and then maybe we can have a conversation about taxes. But that's a much bigger conversation.
All right. Well, I want to thank you very much once again. This is the preeminent financial analyst on Wall Street, and it's my great pleasure to have him on the program. Once again, get yourself available of the Financial Technology Investor newsletter published by Agora. Chris, why don't you send me a link to that, and I'll send it out to all my people when I get it. And also, Ford Men, From Inspiration to Enterprise, 2 really great pieces of work, and thank you so much again for coming on the Pentonomics program.
Anytime, Michael.